Hello there, my name is Patrick Kamau Kamure, where I continue teaching you about advanced taxation. And as I remind you from where we have come from, we started with the taxation of the business income. The topic is about taxation of the business income. And we say there are two businesses that we needed to look at. The first one is the taxation of the partnership, which we did cover. Taxation of the limited company was the second one. Under the limited company, we say there are various areas that we need to look at, actually 6. We talked about corporation tax, installment tax, taxation of the group of company, taxation of specialized company, compensating tax, and shortfall distribution tax. Now, we are at the taxation of the specialized companies, where so far we have been able to look at 3 specialized companies. That is, the first one was the taxation of the bank. The second one was taxation of the insurance company, taxation of cooperative society. So we look at the 4th specialized company. That is now the taxation of the petroleum company. And you can see it's not just the petroleum company. We are talking about taxation of petroleum companies and petroleum company service subcontractors. So these are 2 companies in the same sector that I want us to look at. So we start with the first one, being the taxation of the petroleum companies. What are these petroleum companies? The petroleum company we are talking about here is not about the company that normally sell the petrol or oil with the petrol stations. We are talking about the company that usually extract oil. For example, there is one in Kenya which we call Taro Oil. It's doing the extraction of oil in Turkana. So that's the one that you're talking about, the one that extract, maybe refine, and then sell the petroleum product. That is the one that I want us to look at, how it is usually taxed. Now, these are the points that you need to know about the taxation of this petroleum company. First, we look at the definition. So we have the points to note. Number 1. The first thing that we have done is to define, whereas we have said petroleum companies are companies involved in exploration, extraction, storage, and selling of the petroleum products. So petroleum products is anything that come out of the petroleum crude oil. For example, the natural gas, the diesel, any fuel in nature that is usually extracted from the petroleum product. So that is the one that I want us to look at. Point number 2. The next point that we need to know is that the petroleum companies are taxed on their taxable incomes, determined using either, like any other business, we either use the gross profit method or the net profit method. If you are given net accounting profit, net profit method. If net accounting profit is not given, then we use the gross profit method. That is point number 2. Point number 3. Yeah, so what we need to note that petroleum companies are company like any other. So we need to determine the taxable income, and then we apply the corporation tax rate to know the tax that is supposed to be paid by the petroleum company. So we normally apply the corporation tax rate on what? On the taxable income. So you get the taxable income. If it's a resident company, tax it at the rate of 30. If it is an unresident company, tax it at the rate of 37.5 to get the tax that that company is supposed to pay. That is point number 3. Point number 4. We have an additional taxable income when it comes to the petroleum company. Since it is a specialized company, when you talk of additional, it means that other than the income that we said are taxable for a normal business, like realized foreign exchange gain, discount received, this is also a taxable income when it comes to the petroleum company. And you are saying this taxable income is additional any income from selling of the petroleum product. Petroleum product is what the petroleum company extract from the crude oil. It can be a natural gas, it can be diesel, it can be petrol. So when they sell and make an income, that is supposed to be an additional taxable operating income. Point number 5 to note about the petroleum companies. So we have the additional allowable expense for the petroleum companies. These are other than the normal allowable expense that we talked about under the normal business or general business. These are for the petroleum company and they are allowable. They are. So we are talking about one of the additional allowable expense is any expense relating to drilling of a well. These expenses are which one? You'll hear the them being named as. So all these are considered to be a drilling cost of a petroleum company. Geological, geophysical, and geochemical study cost. We have the cost of determining where the well is supposed to be located, cost of cleaning the well, cost of maintaining the well, and any other cost that is related to drilling of a well. You'll hear them sometimes being called intangible drilling costs. It doesn't matter. All these are supposed to be allowable expense. Number 2 of another additional allowable expense So we are saying that any amount paid to the government in addition to the petroleum agreement, that sometimes you can find that the petroleum company, for it to operate in Kenya, they may enter into an agreement with the government that whatever income they get, some of it has to be paid to the government. That is supposed to be allowable. But this should not include the taxes. Taxes are paid by all businesses. So that tax is not supposed to be an allowable expense. This we said for any kind of a business. Point number C is the amount paid to petroleum company service subcontractor. When you talk of petroleum company service subcontractor, is any other company that is contracted by the petroleum company to help in the oil exploration. So when that company offers the service, it is paid for the service rendered. That is supposed to be an allowable expense. Number D, another allowable expense, it is the production expenditure. When you hear of production expenditure, these are the day-to-day expenses incurred by the petroleum company. So day-to-day, like salaries for the staff, communication expense, fuel for the machine, all these are supposed to be allowable expenses. Then after that we have E, another allowable expense, that loss brought forward from the previous years. That if a petroleum company made a loss in 1 year, this is pushed to the next year. And then next year, before you tax that profit, deduct that loss from last year. If you're not able to make profit in that year, carry it forward to the third year, to the fourth year. And that is done indefinitely. And that is very important because you can be asked, for example, one of the incentives that the government has given to the petroleum company for investors to come and invest in petroleum operation is this one. They are told that you can carry forward a loss indefinitely as long as you are in the operation. Another allowable expense, in this case we have F. It is the commissioning and mobilization costs. This we normally say are the expenses that you incur to take resources to the well site so that mining of oil can start. Those costs that you incur, for example, to take machines there, to take the labor, the workers there, those are supposed to be allowable expenses. Then we have G, another allowable expense. We have what we call decommissioning and demobilization costs. Now, these are the costs incurred to take away the resources from the well site after you stop mining. For example, once you're done with mining with crude oil, and now you want to close that well, it can no longer produce any oil. In that case, you move your machine to another area. You move your workers to another area. That is what we call decommissioning and demobilization cost. And it is supposed to be an allowable expense. Another one, it is the cost of a well abandoned on failure to discover oil. A petroleum company can sink a well with the intention of getting oil. It incurs costs. And then it realizes that once they get down there, there is no oil. So they have to move to another area where they try to sink another well to look for oil. That well produces an oil. So what you are saying is that the cost that was incurred to sink the first well can be transferred to this one that has been sunk and produced oil. So before we tax the income from that oil, we deduct the expense from the previous well. Another one, we have the extraction or oil lifting cost. This is the cost that is incurred now to extract the oil from underground to bring it to the surface for the processing to start. Another one, So another one that we have there is what we call Petroleum Investment Allowance, or called PIA. Now this is granted on these items that are directly used in the process of mining the oil. So we are saying we normally give them petroleum investment allowance at the rate of 50% in the first year of use, and then 25% reducing balance from the second year. So what I'm trying to say that only the name change. The concept is made the same as we talked about in the investment deduction when it comes to the manufacturing. So that is what we call the petroleum investment allowance. Then we have the last one, wear and tear allowance. Yeah. So when you have an item that qualifies for wear and tear, give it the wear and tear allowance like a normal business. So these are the additional allowable expenses when it comes to the petroleum company. Otherwise, the normal expenses that we say they are allowable for any business, they are also allowable for the petroleum company. So those are the points that you need to note about the taxation of the petroleum company. And now at that moment, we should look at a question about the taxation of the petroleum company. But before we do that, we can also look at the petroleum company service subcontractor, also called PSS. It's a short part, and I want us to look at it before now we look at a question on the taxation of the petroleum companies. We look at the taxation of petroleum companies service. Now, just as the word say, we are talking about a company that is subcontracted by the petroleum company. So how do we tax it? These are the points to consider. Should use the black pen. That is the first thing that you should be able to note, that these are companies which are subcontracted by the main contractor, the petroleum company, to provide some specialized services. And so they provide and then they are paid for it. Point 2. That's another point that we need to consider when you're taxing a petroleum company service subcontractor, is that they are taxed on their taxable income at an unresident corporate tax rate of 37.5%. So the rate that we normally apply is 37.5%. Even if that company is a resident company, we don't normally care. We tax it at an unresident tax rate. And another thing you need to note, that tax is usually the withholding tax. So it is supposed to be withheld by the company paying, which is the petroleum company. And once it is withheld, it should be remitted to the KRA by 20th of the month after the month of withholding. So just the same way for all the withholding taxes, by 20th of the following month, that money should be paid to the KRA. And the last one is that withholding tax is final tax, that there's no other tax that is supposed to be paid by that subcontractor. Then we have point number 3 and the last one. Another item that you need to take or to consider is that the taxable income, the one that we have said we tax at the rate of 37.5%, is not determined like a normal business where you use the net profit or the gross profit method. No. This one, the taxable income is taken to be just 15% of the amount received from the petroleum company for the service rendered. So here we are not talking about expenses, we are not talking about the income. Just 15% of whatever they receive from the petroleum company, and that becomes the taxable income, nothing more. So this is what you need to know on how we tax the petroleum company service subcontractor. At this moment then, we can look at a question. And the first question that we are going to look at comes from November 2015, question number 4C. November 2015, question number 4C. I read the question. Rigs Drilling Limited is a mining company dealing with petroleum products. During the year ending that 1st December 2014, the following details were extracted from the company's financial statements. We have the geological costs, exploration drilling costs, acquisition costs, lifting costs, lease operating costs, cost of refining crude oil, oil and natural gas revenue, depreciation and depreciation, share-based compensation, general and admin expenses, reversal of litigation expenses, finance expenses, decommissioning cost, drilling machines, investment income, impairment losses, intangible drilling cost, professional fees, loan repayment, tractor, derivative oil losses, restructuring expenses, and forklift. Additional information number 1, intangible drilling costs include for 20,000 for a well which failed to yield crude oil and was abandoned. Number 2, restructuring expenses include 582,000 paid to the consultancy firm that restructured the capital structure of the company. Exploration drilling costs include plant and machine 4,800,000, erection of rigs and tankage 1,600,000, pipe and storage tanks 94,80,000, factory building 48,400,000. Number 4, professional fee include 800,000 for service provided by the general manager of the parent company. We are required to get statement showing the taxable profit or loss for the year 2014. Now we take note that this is a petroleum company, not a subcontractor. For the petroleum company, we said we determine the taxable income using either net profit or gross profit method. Now for this question, you note that there was no net accounting profit provided anywhere or net loss provided anywhere. So in this case, we cannot use the net profit method. Automatically, it means that we use the gross profit method. So we start. With the taxable operating incomes. So we look for them first. The first item, so we are looking for taxable operating income. Geological cost, that is not an expense. It's not an income. Exploration drilling costs are not an income. Acquisition costs are cost and expense. Lifting costs and expense. Lease operating costs and expense. Cost of refining crude oil and expense. Oil and natural gas revenue. A taxable operating income from selling petroleum product. Then we continue. Depreciation and depreciation, no. Share-based compensation, that's not an income. General admin expense, reversal of litigation and expense. Finance expenses, decommissioning cost, drilling machines, investment income, that is investment. We know that investment, this being a company, will come later after getting the net taxable operating income. Impairment losses and expense, intangible drilling cost and expense, professional fee and expense. And then the next one is the loan repayment. That is a loan, not even an expense. Tractor and expense, derivative oil losses and expense, restructuring expense, forklift and expense. If you look at additional information, number 1 is talking about intangible drilling cost and expense. Number 2, restructuring expense, exploration drilling cost and expense, professional fee and expense. There is no other income. A taxable operating income. So we now look for allowable expenses. So this we go through the question. Any allowable expense we post. The first item is geological cost. We say that is part of intangible drilling cost and is allowable. Geological cost. Another is the exploration drilling cost. We say the drilling cost is allowable, but that has an additional information number 3, where we are told that exploration drilling cost include plant and machine. That's a fixed asset we don't allow. Erection of rigs and tanks, fixed asset. Pipeline and storage tanks, fixed asset. Factory building, fixed asset. Those we not allow, so we deduct them. We have 146,400, and then we minus 4,800, we minus 1,600, we minus 94,80, we minus 48,400. Give us 82,120. After that, we need to note that this being fixed assets, we need to claim capital allowance. And if you look at the first one, plant and machine, we say that is petroleum investment allowance. Rigs and tankage, those items that are specifically for petroleum activity, petroleum investment allowance. Pipe and storage tanks the same, factory building the same. So we claim, we have on plant and machine, we have 50%. We said that first year is 50%, 4,800. Rigs and tankage, another 50%, 1,600. The other one is pipe and storage tanks, 50% of 9480. Factory building, 50% of 48,400. So 50% of 4,800, that should be 24. The other one is 50% of 1,600, that is 800. 50% of 9480, give us 4740. And then 50% of 48,400, 24,200. So we are done with the second expense, exploration drilling cost. We go to the third one, acquisition cost. Now about acquisition cost, it's not specific what they acquired. Are they land? Are they machine? We are not told. You cannot assume. So we ignore if it's not specific. That's what we said. Lifting cost, we said that is allowable expense. The other one is lease operating costs. That is another allowable expense. We have been saying all this. The other one is cost of refining crude oil. That is supposed to be an allowable expense, refinery costs. The next one is depreciation and depreciation. We said for any business, depreciation is not allowable. Same case to depreciation. Share-based compensation, that is not an expense. We don't know what they compensated. They were compensated or they compensated. General admin expenses, that is an allowable expense. Then reversal of litigation expenses. You need to know litigation expense, this is legal cost. Legal cost, we said are not specified among the one that we said we don't allow. It's always allowable. The next one is finance expenses. That is an allowable expense. Finance, like interest. The next one is the decommissioning cost. That we said is allowable expense. Drilling machine. That is a machine specifically for mining, which we said they all qualify for petroleum investment allowance. So we have the next one is impairment losses. Impairment we said is not allowable. Intangible drilling cost, that is allowable. We said that, but we have additional information. Number one, intangible drilling cost include for 20,000 for a well which failed to yield crude oil and was abandoned, which we said that is also supposed to be an allowable expense. So allowable. So the whole of it is allowable, 34,820. The next one is professional fee. Those are allowable expense. Audit fee, legal fee, accountancy fee, allowable. But there is an additional information. Number 4. Professional fee include 800 for service provided by the general manager of the parent company. Another company, we don't allow that. That need to bear its own cost. So we will have 2,600 minus 800, giving us 1,800. After that, we have loan repayment. Loan is not even an expense. You are paying back money you had borrowed. That is not even an expense, so you don't allow. Tractor, that is an item for wear and tear, 25%. So it come here. 25% of 1,500 give you 375. After that, derivative oil losses. You need to know that derivative oil losses are like foreign exchange losses. So unless you are told unrealized, they are always allowable. Restructuring expenses. That is another allowable expense. But there is an additional information number 2. Restructuring expenses include 582,000 paid to consultancy firm that restructured capital structure. Capital is a long-term expense that is not allowable. So we need to deduct it. $848 minus 582 give us 266. After that, forklift. That is an item for wear and tear 25%. So 25% of 1800, 450. Now, when you go to the additional information, number 1 about intangible trading costs that we had accounted, restructuring cost the same, exploration trading cost the same, professional fee the same. With nothing more, we can now get the net taxable operating incomes. So from operation, how much is supposed to be taxed on this company? Here we have to start with the taxable operating income, which is only 1 minus the allowable expenses. So 98,40,000 minus 84,680 minus 82,120 minus 2,400 minus 800 minus 4740 24 200, we minus 12,600, we minus 64,780, we minus 18,240, we minus 78,340, we minus 96,80, we minus 6,400, and then we minus 4280, we minus 9150, we minus 3420, we minus 1800, we minus 375, we minus 480, minus 266, we minus 450, give us 9430, 799. So from operation, that is what is supposed to be taxed. But this being a company, once you get the operating income to be positive, we add taxable investment incomes, of which case we only had one investment income for this question, for 64,000. So we have 464,000, and we say if you're not told where an investment income is coming from or any other income, you tax. You treat it as a taxable income. So now we'll take the 9430, 798, 799. We add 464,000. That gives us 9894. $799, and that is the total taxable incomes of that company. We look at the question once more to determine whether we have really answered the question. In the required, we were supposed to just get statement showing the taxable profit or loss for that year, period. And that is exactly what we have done. So there is no other thing that you're supposed to provide. However, if they could have asked for the tax, then you could have taxed at the rate of 30% to get the tax to be paid, because it's a company and it's a resident company unless you are told it's a non-resident. That is how you answer such a question. I'd like us to look at another question. This time, we get it from April 2022. April 2022, question number 3C. April 2022, question number 3C. This is what the question says. Paletto Limited is a company in the business of exploration and production of oil and natural gas in your country. The company reported a petroleum profit of 143,600,000 in the year ending that 1st December 2021. This figure excludes crude oil produced but not sold, valued at 4,200,000. The expenses comprised of capital and revenue expenditure were deducted in arriving at the reported profits. We have geophysical staff salary, legal costs for title deeds, dry hole contribution, drilling and test development costs, capitals from the previous year, memorandum of understanding credit, royalties on domestic sales, royalties on export sales, non-productive rent, custom duty on plant and equipment, purchase of assets for offshore operation, provision for restoration of a well, petroleum investment allowance. Additional information number 1, petroleum investment allowance incurred included depreciation of equipment 378,200, offshore operation included a tractor purchased at 920,000 for use in the on site in your country. Computer and computer software was 780,000 and 360,000 respectively for use in the country offices. The offices were partitioned at a cost of 1480,000. So we are required to have a statement of computation of petroleum profit or loss for accounting year 2021 and the tax payable, if any, by the company. For this one, we take note that we are given a reported profit. So that automatically means we are supposed to use the net profit method to get the taxable income. So the question is from April 2022, 3C. So we look for, as we said, non-allowable expenses in P&L, and then later on we look for taxable operating income omitted in P&L. So for this one, we note that we are told very clearly the 143,600,000 in the year 2021. This figure excludes crude oil produced but not sold. So if the crude oil was produced and not sold, remember it formed part of the closing stock. But we have been told the figure exclude, it had not been accounted for when you're getting the reported profit. It's like you don't deduct a closing stock to get the cost of sales. If you don't deduct, you expect that the net profit will be less. So when the net profit is less, you need to now come and add it here. We have crude oil. After that, towards the end of the first paragraph, we are told the following expenses comprised of capital and revenue expenditure were deducted. So the expenses were deducted to get this profit. So we need to just add back the non-allowable expenses. The first expense is geophysical staff salary. That you remember we said that is a allowable expense. Legal costs for title deed. Title deed is land. Land is a fixed asset. We say legal costs relating to fixed asset we don't usually allow. So we add it back. Then dry hole contribution. That is like the cost of drilling a well. So that is allowable. Drilling and test development costs, those we said are allowed. Capital losses from the previous year, allowable. Memorandum of understanding credit. You need to know that maybe we didn't mention, but if you see memorandum of understanding credit, it is usually allowable expense. It is allowable. Royalties on domestic sales. We say that any kind of royalty, patent, copyrights, we don't allow. So royalties on domestic sales and royalties on export sale, we don't allow. Then, non-productive rent. Again, this maybe we didn't mention, but now we are mentioning. Non-productive rent for petroleum company is allowable. According to the Income Tax Act, it is stated that that is allowable. So we won't add it back. Custom duty on plant and equipment is a form of tax relating to fixed assets. Fixed assets we don't allow, and form of tax we don't. The next one is purchase of assets for offshore operation. Assets. Assets are not allowable expense. Fixed assets, they are fixed assets. And although we are told in additional information number 2, offshore operation included tractor purchase at 920 for use in the site in your country, that is still a fixed asset. So we don't allow the whole cost because they are fixed assets. The next one is provision for restoration of wells. That is not allowable. Provision is never allowed. The other one is petroleum investment allowance. That is allowable. It's a capital allowance and it's allowable. Now we go to the additional information. We check if there's still some expense relating to the one in the P&L which is not allowable, or there is an operating income taxable which has been omitted in the P&L. When you go to additional information number 1, say petroleum investment allowance include depreciation. Depreciation is not allowable, and we are told it's in the petroleum investment allowance which had been deducted. So we add it back. Depreciation of equipment. Then number 2 that we talked about already, we said it's in the offshore assets and it's not allowed. It's already in here. The whole of it is in here, the whole of it, and it's not allowed. About number 3, computer and computer software was for 780 and 360 for use in the country offices. Those are not allowable, but they are not relating to the one deducted in the P&L. So we cannot add them back. Number 4, the office were partitioned at a cost of 1480. Again, that is not allowable, but it had not been deducted. Yeah, so we cannot add it back. So these are the only ones that we add back. From there now we come to leasing. Now we start with non-taxable operating incomes in P&L and all the investment incomes in P&L. But in this question, the only incomes that we were given were 2. The reported profit, which actually we are adjusting, and the value of the petroleum product not sold. The whole of the question, there is no other income. So we cannot talk of these 2. For this question, they are not applicable. So we now look for allowable expense not in P&L. An expense that was supposed to be deducted to get this profit, it wasn't deducted. That we can only then find in the additional information, because the expenses already given, we are told they had been deducted. So now we go to the additional information, we look for allowable not in P&L. A petroleum investment allowance, that is already up there, had been deducted. About number 2, the tractor, that is already in the cost of assets in the P&L. Computer and software, they were not deducted, but they are not allowable. Instead, what we allow is the wear and tear allowance. So we deduct, which we have computer, 25% of 780. That is the wear and tear allowance, 195,000. The other one is the wear and tear allowance again, for software, 25%. Software 360. So 25% of 360,000, 90,000. And then we go to number 4. The offices were partitioned. That again is not in the P&L, not allowable, but we allow wear and tear for partition. The rate is 10% or 1480. $148,000. After that, there isn't any other. But we say that before you say it's over, look for the expenses you added back. Maybe there was a fixed asset that require capital allowance. Crude oil, legal cost, royalty, those are not fixed asset. Custom duty. Now for plant and equipment, it's a fixed asset. Custom duty, plant and equipment. But this one, it's under petroleum investment allowance, which had already been deducted in the P&L. So we cannot deduct it again. Purchase of assets. Now for those assets, we are not told which ones are they. Except one in additional information, number 2, the offshore operation included tractor at a cost of 920,000. So tractor, we know that is wear and tear 25%. So we continue. So 25% of 920,000. So that gave us of 920,000 230. And there is no other, because after that we have provision, depreciation, it's not, nothing more. So in that case, here we have one that maybe we added, the petroleum investment allowance. This was the depreciation. Okay, it was the depreciation. Okay, so we don't have another one that we can claim capital allowance. With that, we get now the net taxable operating income. So that will mean we start from here, add, minus. So we start 143,600,000, and then we add 4,200,000 plus 562,400 plus 3,600,000 plus 5,760,000 plus 672,300 plus 7,840,000 plus 15,75,000 and then plus 378,200, and then we minus 195,000 minus 90,000 minus 148,000 minus 230,000. Give us 167, 524, 900. And we can see from operation, the business had a positive figure. And this being a company, we can now add taxable investment incomes, which in the whole of the question, we didn't have any investment income. So meaning this 167, 524, 900 become our total taxable income. Of which case, that required number 1 is answered. Required number 2 is about tax payable. So tax payable. This being a resident company, 30% of 167, 524, 900. So there was no investment income that we can deduct the withholding tax. So we just tax the income 167, 524,000, and then this one give us 50,257,200. And that is the tax that is supposed to be paid by that company. And all the questions have been answered. Now that brings us to the end of the taxation of the petroleum company as the fourth specialized company. So I'll give you practice question that you're going to look at for your own practice. The first question is November 2020, question number 2A. November 2020, question number 2A. The other one is May 2018, question number 4A. May 2018, question number 4A. Now that brings us to the end of this class and lesson. So next one that you're going to meet, we continue looking at the taxation of specialized company. This was number 4. So we now go to the specialized company number 5, which we talk about taxation of gain on transfer of property. Taxation of gain on transfer of property. For now, I wish you well. See you in the next lesson. Thank you very much.